FHA, FHA, FHA loans. Watch this video. You're going to learn everything you want to know about an FHA loan. Hey, this is Chris Trapani, the Mortgage Pro. You know, people ask me, Chris, what is the easiest loan for me to qualify for a first-time home buyer, somebody who has a down payment and provable income? Here's probably the right program for you. We're going to start with step number one. Here's how it works. Step number one, an FHA loan. You need a 3.5% down payment. So if you're buying a $400,000 house, 3.5% is $14,000. That is the minimum down payment. You only need a FICO score of 580 and above to be able to qualify for that. Now, 579 FICO and below, it's a minimum of 10% down. Not negotiable. This is how it works. So you know what the down payment is. Now, step number two, income. Well, first of all, let's take a look at income. If you're self-employed, what you need is the provable income, your net after taxes. See, a lot of times people come to me and say, hey Chris, I make $100,000 a year, and I look at the taxes and they grossed $100,000, but they only pay taxes on $45,000. So that's what the actual income is if you're self-employed. If you're W-2'd, then we're going to pretty much take your W-2 income, we're going to average it over a couple of years. If you have a salary, that's your salary, $5,000 a month. I don't care what you made the last 2 years. Your salary, $5,000 a month, you're good on that. Otherwise, we're going to look at hourly pay. Here's a simple formula. If you get paid and work 40 hours a week, take the hourly pay times 173.333, and that'll tell you how much money you make per month. A simple example, $10 an hour, that is $1,773.33 a month. That's how we look at the income. Because remember, you say, hey, I get 4 paychecks. No, you actually get somewhere around 4.3 if you're paid weekly. And if you get paid twice a month, there's going to be 2 times a year where you're going to get an extra paycheck. Well, we're going to add that in to build your income up. If you work overtime, we need a 2-year history of overtime pretty much, and we're going to average the overtime. You can't say, hey, I worked 2 hours overtime last week. What's the average for the last 2 years? And that's what we're going to give you credit for. If you receive bonuses, again, 2-year average for income. And commissions, 2-year average for income. So we take the income, whatever we calculate it, it's not how we want to do it, it's what FHA, HUD requires. They have a guideline and a rule book, and it must meet those guidelines. And we add the income up, and we're going to teach you about the debt ratio, what's allowable. Step number 3, you have to have a 2-year employment history. Why do I need a 2-year employment history? Because they have to know that you've been working for 2 years. Now, the only exception to that is if you go to school, if you went to college, maybe you didn't have a full-time job, maybe you went to a certificate type program and you went for a year. Basically, what happens is we're going to use that in lieu of the experience. So, somebody who just graduated from college, they may not have worked ever, but they get their first paycheck, we can use that income. Somebody who has a certificate program, we're going to look at, hey, you went to school for a year, they're probably going to ask you for a year on the job or in some kind of work history on top of that. And if you've never been to college or don't have any kind of degree or technical training, what they're going to do is they're going to require 2 years. Now, if you've been working 5 years or 2 years at McDonald's and now you got a job working as a police officer, great, we got your police officer income. We'll use whatever the income is pretty much within the guidelines, within the rules, but we need, on most cases, a 2-year history. Step number 4, debt ratio. I told you earlier in step number 2 we were looking at debt ratio. Now, if somebody makes $10,000 a month, let's say a family, husband makes $5,000, wife makes $5,000, they make $10,000 a month, we're going to use 47% as the guideline for a house payment. Hey, that's $4,700 a month. And we're going to use another 10%. So 57% is what we call the back end, and that can include all your debts. What do I mean by this? Well, if you have a car payment of $500 and another car payment of $500, that's $1,000 a month. If you have student loans and credit cards and all those type of things, let's say they add up to $2,000 a month. Well, at 57% of the $10,000, that is $5,700. Let's take those $2,000 in debts off. That includes child support and alimony, by the way. So that would bring it down to $3,700. $3,700 is the max housing payment you can have. So you must hit the 47% for housing payment and the 57% for house plus the debt payments for your debt ratio. That's a requirement on FHA, and it's a pretty easy guideline to work with. Step number 5, credit. Earlier I told you that if you have a 580 and above on a FICO score, you can buy with 3.5% down. Lower than 580, 579 and below, it's 10% down. But there are some requirements and some guidelines and rules. For example, bankruptcy. 2 years must have elapsed. If you've had a bankruptcy, hey, FHA is pretty forgiving. Once 2 years have elapsed, not from the file date, but from the discharge date, you can again qualify. It's 3 years for a foreclosure or a short sale, and after that time period, you can qualify. Now, where we come into some problems, that even though sometimes people have a good FICO score, a high enough FICO score, is on student loans. Sometimes they ignore the student loans and they're in collection, and they must be out of collection. You must be proving that you're making the payments. And I know a lot of you say to me, hey Chris, my student loans are in deferment. Well, you're gonna have to pay them back sooner or later. So what we're gonna do is we're gonna use 0.5% against you. So if you have $50,000 in student loans, 0.5% is $250 a month. I make believe you have an extra $250 a month car payment. That's how it works. Now, if you're in a plan where you're only paying $50 a month, I get to use the 50. So sometimes it's better to make arrangements to start making payments. But before you do that, talk to me or one of my associates. Now, we have all kinds of different collections. Sometimes people have collections on, very common, on medical. We don't have to hold them against you at all, but they do lower your credit score. But we don't have to hold them against you. If you have outstanding collections, that not medical, that total over $2,000, then we're going to use 5% of them against you. So if you have a $5,000 Capital One card that you were charged off on, 5% on a collection is 2.5%. Oh, by the way, did I say charge off? Charge-offs do not have to be paid back. So they are not held against you at all. They lower your credit score, but they're not going to be held against you. Now, if your score is so low, I want you to contact me, because sometimes we know tricks, we know tips, we have tools that can help you raise your credit score. There are things that most people just don't know about doing it. I also have credit repair people who will work with you to raise your credit score. Now, I know what you say. A lot of people say, hey Chris, I don't want to spend that money on credit repair. Well, here's the truth. Whatever you spend on credit repair is going to save you money. What do you mean? Well, you get a higher credit score, you get a lower interest rate. So whatever you're going to spend on credit repair pretty much is going to wind up coming back to you in a year or two or less. Just by having a better credit score, you're going to have a lower interest rate. So take advantage of that. Now, here's some tips. If you don't want to go through my credit guy, who gives you a discount just because you say you talk to the fire your landlord guy, and you go to your own person, here's what you never ever do. I don't care who they are. Do not pay them a monthly fee. What do I mean? Well, a lot of these companies, hey, it's only $100 a month, or this law firm, $129 a month. Well, great, but I want you to think logically. What is their incentive to hurry up and get it fixed? Or would they rather drag it out and keep you paying $100 or $129 a month? Don't do that. Go with a reputable company who's going to charge you a lump. Sometimes they split it up into two or something for you, but they're going to charge you in a lump, and they're going to tell you this is how long it's going to take. That's what you're looking for on credit. Step number 6, money, seasoning. What does seasoning mean? Well, you couldn't just put the money into your bank account yesterday because we need 2 months bank accounts. So if you put the money in yesterday, we're going to say, where did that money come from? Well, it came from my cousin Charlie. Okay, well, give me cousin Charlie's bank statement. We need to prove where money comes from unless it's already in the bank, because we need 2 months bank statements. The reason for that is a lot of people have cash in the mattress and they put cash in the bank. Well, you can't prove where it came from, and HUD, the government basically, doesn't know if it came from Al Qaeda or El Chapo. They have no idea where it came from. So we don't want to deal with that. If you have it in the bank for 2 months already, we're good. And if it just went in, show us a check, show us proof, show us where it came from. If it's cash, you'll have to wait until 2 months have expired and show me 2 months bank statements without that deposit before we can use it. So seasoning is a very important factor. Step number 7, where do I get the down payment from? Well, you can take it obviously out of your own savings, your own checking, or sometimes people take it out of their 401k. And people get gifts. Hey, grandma gave me a gift of $1,000 and grandpa gave me a gift of $2,000, whatever. We have to track where it came from. I need their bank statements, and I'm going to need a special gift letter form. Now, when I said grandma gave me $1,000 and grandpa gave me $2,000, I want you to think a little bit different. Many years ago, I helped a family. They had come from Mexico. They were so proud. They worked on becoming American citizens. They were so proud. Their goal was to buy a house. Now, they were 8 brothers and sisters. And what they did was this. They had a hard time saving the money. So the oldest brother had about $4,000 saved. And the other 7 brothers and sisters, what they did was they each gifted him $1,000 each. We had to go through all the paperwork, and we had to prove it was their money, but they each gifted him the money. And what happened was, soon after, the next one, he had saved some money, and they all gifted him $1,000. And they did this, and it took 1.5 years, and they gifted each one of them $1,000 apiece until they even got their own $1,000 back. In a way, it wasn't a loan, it was a gift, but they helped each other buy a house. The reason I'm telling you this story is because I want you to understand that there's not just one way. It doesn't have to be somebody who's gifting you $10,000. There's a lot of ways to skin the cat with a gift, as long as you're being legitimate and people will show the paperwork. There's a lot of ways to do it to fire your landlord. What paperwork are we going to need? Well, the documentation works like this. For most people, we're going to need 2 years income taxes. Now, if you've just been on a job and you are W-2 and you get a salary, very often we can just get away with 2 years W-2s. But let's assume you need the taxes and the W-2s for 2 years. And we're going to need 1 month's pay stubs and 2 months bank statements, and if you have a 401k that you're taking money out of, the last 401k statement. Now, we also need proof of ID. We need driver's license and social security card, and that's pretty much how we're going to get started. Now, many times one thing opens up a can of worms. Sometimes an underwriter looks at a bank statement and says, hey, what is this non-sufficient fund? Or what is this $130 for? And that it looks like in 2 payments, you have 130 and 130. Who are you making payments to? Because it's not on your credit report. So these kind of things come up. So sometimes we're going to need more documentation than that. If you've been divorced, we are going to ask for a divorce decree. If you've had a bankruptcy, even if it's after the 2 years, we are going to ask for the bankruptcy discharge papers. So there's extra paperwork. There's always going to be lots of paperwork. There's nothing we can do to avoid it. It must be to meet the guidelines. Number 9, thing you should know. FHA does not do loans. What they actually do is insure the loan. Now, think like this. Would you lend somebody $400,000 without checking on everything? Of course not. You want all the documentation, you want all the paperwork, you want proof that they actually make the money and they pay their bills on time, and a whole myriad of things that they need to see. And the reason they need to see it is they insure the loan. Now, once they insure the loan, that means that we can sell the loan. No lender can sell the loan if HUD says, hey, you don't meet the guidelines. So they would make us buy the loan back. And that's the reason that there's sometimes a mountain of paperwork, and sometimes it's pretty simple. It all depends on your situation. Loans are as different as fingerprints. Everybody has a different situation, different income, different credit, money's coming from somewhere else. So we have to put together the loan and look at it as a whole, and it has to meet the guidelines in order for it to be insurable so that we can do the loan for you. Item number 10 is PMI, mortgage insurance. What is mortgage insurance? Mortgage insurance is based on a risk that the lender takes. Now, HUD offers a pretty decent deal on mortgage insurance, especially for people with lower FICO scores. But what it basically does is, without mortgage insurance, you would have to wait until you had a 20% down payment before you could even buy a house. So even though nobody wants to pay the mortgage insurance, you kind of have to say, thank you for the opportunity to pay mortgage insurance. Otherwise, we'd have to save all this extra money or we wouldn't be able to buy a house. Now, if you live in certain states where they have $50,000 houses, okay, 20% is $10,000. But here in California, you buy a shoebox for $500,000 and you're lucky to get that. Most people can't save $100,000 in a timely manner. So that insurance, the PMI insurance, makes it easier for you to buy a home. Now, after you've been in a home for a while, if you have enough equity, more than 20%, very often we will do a refinance at that point to get rid of the mortgage insurance and lower your payment. But that's for another video. For this time, I just want you to say thanks to PMI and thanks to HUD for that insurance. Otherwise, we wouldn't be able to buy it, most of us. Now I'm going to put all the pieces together. The first thing you need to do when you decide to buy a house is get pre-approved. So what we do is we're going to take your documentation, we're going to put it in an application. It's called the 1003. That's basically the loan application in the United States that we use. And we're going to start to analyze all the information. We're going to look at your income. We're going to run your credit. Yes, you might say, I have my own credit report. We cannot run these reports without a credit report run in the company's name. This is very standard. So we're going to evaluate your credit. We're going to evaluate how long you've been on the job. We're going to evaluate your income. Do you have enough? We're going to evaluate your debt ratio. We're going to evaluate your down payment. We're going to evaluate all these tools, and we're going to enter them all into a computer. And we are going to run it right through Fannie Mae's website for what's called a DU, a desktop underwriter approval. Now, basically what that is, it's an approval saying if you put this information in correctly, and the underwriter will verify that it's all correct, that we will do the loan for you. Now, it's important to understand, garbage in, garbage out. If somebody tells me, hey Chris, I make $50,000 a month, and I put $50,000 a month in, his pay stubs show he makes $3,000 a month, yeah, it spit out an approval, but it was based on garbage information. So what we're trying to do is be as accurate as we can. There's no closes, there's no abouts, there's no guesses, this is no common sense. It's paperwork, prove it, prove it, prove it, or they're not going to lend you all that money. And that's how it works. So we have a desktop underwriter approval. You are now what we called pre-approved. Now, the next step is we're going to teach you, hey, go talk to your realtor. If you don't have one, we will happily give you an experienced realtor, and they're going to start showing you houses. Now, while they're doing that, we take the loan. Instead of just sitting in a drawer waiting for you to shop and buy a home, what we're going to do is we're going to take that paperwork, we're actually going to submit it to an underwriter for what we call a TBD approval, to be determined. We don't have a property yet. So the property is to be determined. And we'll say, if you say, hey, I need a $300,000 loan, we're going to go as high as we can, maybe $325,000, just in case. You don't have to go that high. And we're going to apply for the approval for as high as we can get it. And the underwriter is going to review all the documentation and say, hey, it's pre-approved. It's fully approved, underwritten approved. So what does that do? It's really important. Instead of your realtor going out and saying, hey, we're making an offer for $300,000 on this house, here's the pre-approval, you get to go from a position of strength. Hey, here's a loan that is already approved for $300,000. And the seller and the listing agent are going to say, hey, that's a strong offer. It's already underwriter approved, and it makes yours kind of go to the top. That's a really big deal. Now I'm going to teach you something and a way to think about the loan process and the loan business. It is often a very stressful time. They ask for paperwork, and sometimes it's very simple if all your ducks are in a row, and sometimes your things just aren't perfect, which is an FHA loan is perfect for that situation. Now, if we look at it from that perspective, I want you to understand that it can feel very intrusive. Hey, why do they want to see this? Hey, why do they want my divorce decree? Hey, why do they? And there's mathematical reasons, there's logical reasons, and there are guideline reasons. And I am, and a good loan officer will be kind of like your defense attorney. We have to build a forensic case on paper proving that you meet the guidelines beyond a reasonable doubt. You must meet those guidelines, or remember, we have to buy the loan back and sell it at a $100,000 discount. We're not going to do that. So we have to prove it. I'm your defense attorney. Your loan officer is your defense attorney. The underwriter who approves or denies the file is judge, jury, and prosecuting attorney. They are making believe you are lying, cheating, and stealing to get this loan. So we have to prove to that underwriter, just like to a judge or a jury or whatnot, they say you're innocent until proven guilty. Yeah, try do that in front of a jury. You want to be sure that that's what's happening and you're going to get fully approved. Next step, I want to teach you how to think about it. It is a very stressful time to go through when you're buying a house. You're going to be moving soon. You're going to be packing. You're waiting on the approval. You're waiting on the appraisal. You're waiting on all these things, and it's a very stressful time. And I tell people, and women look at me cross-eyed when I say this, it's a lot like a woman having a baby. You're going through all the labor pains. Husbands, you get to have the labor pain this time. You go through all the labor pains saying, oh no, what's happening? You're going through all this terrible stuff. Now, when a woman has the baby, do they forget the pain? They usually do. Now, if you forget the pain is when you hold the baby. Well, this time, the baby is your house. When you close on the house, you're going to forget about all the pain. We try and step in and be the epidural and make things better and make things more fun for you. So we're going to try and make you laugh through the stressful time. All right, step number 14. This is the best one. We have funded the loan, recorded with the county, and you get the keys and you have fired your landlord. Come join us, come call us, come text us, whatever you need to do, we'll help you do that. Put yourself in a better position, change your family's history, buy a house.